But let's touch base with the management of Burger King India as promised. We have Mr. Rajeev Varman. He's the CEO. He's joining us to talk about the stellar debut and the company's plans forward now that they are officially listed on the exchanges. Mr. Varman, pleasure having you on board. What is it that's giving Burger King an edge over its peers, and what's the company doing to keep up with the changing consumer trends, especially in the post-pandemic era?
Okay, so let me put this in two parts. First is, we have on the business part, if you look at the agreement that's in place, it's a very long agreement until 2039. It gives us an exclusive right to build restaurants in the entire country. It also gives us, the exclusive right to also sub-franchise if we choose to. And in that agreement, we have this journey to build 700 restaurants by December of 2026. So that's the agreement. It's an exclusive agreement, and it's something that is a big asset to this company, right? And on the consumer side, if you look at it, the Burger King brand is positioned with millennials, which is the largest population here in India, but also the largest population eating out of home. So that kind of together with a very strong agreement, with a very strong target audience, and the kind of menu that we have put in, we did an extensive research, and it was one of the largest research I've done in my life, and I've spent over a quarter century in the QSR industry, and this research enabled us to build a menu that does two things. One is it positions the brand in this country as a value leader. And secondly, it also provides a great, exciting, indulgent menu on the barbell strategy. That is the menu architecture that we have put in place to grow this brand from, where we are today at 268 restaurants to 700 restaurants and then beyond.
If you look at the last 2 years, your revenue has grown by more than 2x. Do you see this kind of a growth, this kind of a run rate continue over the next couple of years as well?
Yeah, so, we did about, over 835 CR pre-COVID, the year that ended F20. Now, if you look at the growth, there's two growths that are happening, right? One is the growth of business within the restaurant, and then the second one is the growth of the number of restaurants. So if you would take the following year, this is obviously a tough year for the entire country, and we're all going through it. But, as we normalize and go into the following year, we will continue to build restaurants. I think we're going to be a little cautious in the first year, build about approximately 50 restaurants, but the growth after that is going to be 70 restaurants and then 80 restaurants and so forth. So we are going to continue to kind of ramp up and continue growing the restaurant, but that's the way we build our business. We continue to grow, we build synergies. These synergies help us two ways. One is it helps us to bring down costs within a restaurant by bringing in more supply or bringing in economies of supply from the same suppliers, or bringing in multiple suppliers to provide us economies of scale. So that's one way of doing it. The second is it also now gives us a better chance to use our marketing dollars, gives us higher marketing dollars to actually take a brand to our consumers and bring awareness and build awareness with the consumers.
No, we're witnessing a trend of dine-in making a comeback. Is that the case for Burger King as well? If you could tell us how far along are you from the pre-COVID levels? What is the current status like?
Yeah, so if you look at the fabric of our 268 restaurants, we have restaurants in malls, right? That's a destination zone. People go into the malls, they do their shopping, They watch the movies. Now the theaters are opening up. They watch the movies and then they have their lunch or have their dinner and they exit. Very destination-oriented kind of visit, right? If you look at our restaurants that are, especially in the north, in NCR, on the metro, and those restaurants are again destination restaurant. People get off the metro and buy and purchase and leave. So that's a very strong dine-in business. Coupled to that is our restaurants that are on highways. You're with your family, you're going from one city to another city, you stop by, you take a break, you use the washroom, you get a chance to have a bite and then get back on the freeway. So a lot of our restaurants are destination restaurants and will continue to drive a significant amount of business through dine-in as well, and we continue to see this will continue to grow. Now we have done a lot of work in the past. We were the first ones to jump and move forward with the aggregators when the aggregators came into the country. So we did that. We have also now built our own app. This app, is a fantastic app that we have put together. It has, a lot of things like, a loyalty program. It has the rider journey. It has the best, gaming setup. It has at the back end of it's got, ways of doing analytics and so forth. So it's a great app we have put in place, and we are excited about building a substantial portion of a delivery business onto this app, and we will be doing that over the next several years.
Talking about the bottom line, the company has reported a loss in the last few years. When do you see that meaningfully turn around?
So if you look at if you look the way we look at this business, it's a cash business, it's a cash flow business. We look at our margins as EBITDA margins. We have been positive on that pre-COVID, and we will continue in that trend moving forward. Now, what happens with our business is we have overheads at the office. These are overheads which support the restaurants. So as we continue to build more and more restaurants, you will find that the EBITDA delivered by those restaurants has now already covered the fixed costs or the overheads at the head office. We call it our restaurant support center. And beyond that, they go directly into the bottom line or on the company level EBITDA. So that's the trend we should be seeing moving forward. I will not share any numbers at this point, but we'll start sharing our quarterly results obviously, and you will be privy to them as well.
Mr. Varman, cloud kitchen, drive-through models, they've seen a good growth and traction during the pandemic. Will you be also focusing on scaling up these formats?
No. So we continue to build, drive-thrus. I think if you look at our country, there's an extensive amount of investment in connecting cities, and these highways that are coming up with rest stops, and we will continue to invest and grow in those directions. A drive-through restaurants, gives you the opportunity to experience a brand without actually coming inside of the restaurants. We have also built some inner city drive-thrus, and they're doing well, and we'll continue to look at building drive-thrus as well. I think it's an exciting business, and we feel strongly about it.
Okay. All right. If you could also tell us a bit about the opportunity overall in the QSR space and the growth and the potential for expansion that you foresee.
Yeah, if you look at generally the industry, the expectation of this industry is to grow at a rate of 23% over the next 5 years. And I think that's, if you look back at Technopac's, the last 5 years, I think they've been bang on the money. So they're projecting us to continue growing. And I'm talking about the QSR space or the chained QSR space. So that's 23% growth looking forward over the next 5 years. So I think if you look at post-COVID normalization, they expect that to also kind of in the quarter 3 and 4 take up 10% higher than pre-COVID numbers, and the Q1 and Q2 to kind of basically be those 2 quarters where the numbers will return back to normalcy or pre-COVID numbers.
Mr. Varman, it's been a pleasure chatting with you, and congratulations once again for such a bumper debut on the buses this morning. Burger King India locked in the upper circuit at 135 rupees a piece after seeing a very solid debut on D Street this morning.